Ladies and gentlemen, welcome to the Business Brew. I'm your host, Bill Brewster. This episode is brought to you by Koyfin. Koyfin displays financial information simply and elegantly. Koyfin is one of the fastest growing platforms for financial data and analytics to research stocks and understand market trends. I discovered them thanks to their very passionate users, many of which are my friends. Imagine a Bloomberg Lite with tons of high quality fundamental data, a powerful graph engine that can show it all clearly, and a user interface that doesn't look like it was built in the 1990s. If you're an individual investor, research analyst, portfolio manager, or financial advisor, do yourself a favor and check them out. You won't regret it. Sign up for free at koyfin.com. That's KOYFIN.com. I'm excited to bring you this episode today. Jay Mintzmyer is a great guy. He's also a renowned maritime shipping analyst who directs the Value Investor's Edge research platform on Seeking Alpha. He's a frequent speaker at industry conferences and is regularly quoted in trade journals and hosts a popular podcast, not as popular as mine. He claims it's popular. I'm reading his intro that he wrote me. Why? Because I like Jay. And you know what? He deserves the opportunity to pitch himself, but I digress. Anyway, his podcast focuses on the shipping industry. I wanted Jay on the program because he's a really good guy, incredibly intelligent, BS in economics from the Air Force Academy, MA in public policy from the University of Maryland, and a PhD candidate at Harvard University, where he researches global trade flows and security policy. So the man has got brains. I think the way he thinks is really smart. I like that he is a value guy that chose a niche that he could have an edge in. I will say at one point he quotes his returns. I have not verified these returns. You should do your own due diligence. As always, do not accept his returns as indicative of future results. You should know the drill if you're listening to this podcast. But just in case you don't, none of this is financial advice. All of the information contained in this program is for entertainment purposes only. Please consult your financial advisor before making an investment decision. Do your own due diligence and figure out things for yourself. I make no representation as to the accuracy of what Jay's returns are, but I will say that I will vouch for him as a person, and I enjoyed speaking with him a ton. I hope you all enjoy it. And with that, let's get to the episode. Jay Mintzmyer, how you doing, man? Shipping extraordinaire, fellow investor that suffers from the value disease, current blogger, ex-blogger, what's the deal there?
Yeah, thanks, Bill. That's quite the title, shipping man extraordinaire, or whatever you call it. Yeah, value has been out of style for a long,
Hang on,
time.
We don't need to jump right into it. Let's tell people your bio, because your bio is quite impressive.
Yeah, thanks, Bill. I've been following the shipping industry, which is what I'm most known for now, for about 10 or 11 years. And I started on Seeking Alpha back in the middle of 2011, just writing about value stocks. And after a couple of years, I realized, some of these bigger stocks, Microsoft and Walmart, McDonald's was a value stock, even Apple was a value stock for a while. I didn't really have an edge there. And so I was looking for some sort of dislocated industry. And that's how I got to be into shipping. And that was probably 2012, 2013 when I picked up that industry. And, 2015, 2016, I started a research service, Value Investor's Edge. And here we are today. It's been quite a ride, and I'm looking forward to chatting with you about it.
So as an investor, do you think that, in theory, it makes sense to look at dislocated industries? Or do you think some of riding these compounders makes sense just from because you're a value guy at heart, and I understand what you're looking for in dislocations. But for a portfolio, how do you run your portfolio?
Yeah, of course. I got to be really careful, of course, because I'm just talking about me. And I'm
Yeah.
this as well. This isn't like blanket advice or anything like that. But
yeah,
no, I generally, as I go through the years and I humble myself in the markets, I tend to limit my speculative or my really, personal picks or research picks to a certain percent of my portfolio. And shipping is where I focus. So that's when I'm actually out there picking stocks, I stay right in my lane, which is shipping and a little bit of related energy. So I don't pick anything personal stock related that's not inside my lane. So it's outside of my lane.
Except you had a hell of a call on Dollar Tree.
Right, but this that was
because of
related
your
because it
shipping
was
view.
exactly so it was in the lane. It might have been an
Yeah.
off branch, but it was in the lane, and that's how I get into energy as well. Because if you really want to understand the shipping markets, you have to understand global energy transport and global energy markets as well.
I think Bruce Greenwald would be very proud of you
Ah, well, that'd be flattering.
because when I took like an executive class of his, right, it wasn't like a real class, but I got to spend some time with him, and he I told him that this is back when I banked food companies for a little while, and he was like, "Oh, that's such a good idea because it's cyclical and people are afraid of it, and like you can actually have an edge in that." Um, they're better to bank than to own the equity of in average, but they're fine to trade. But I think that like owning them is a little bit tough. Do you find something similar? I mean, the very first comment I ask for questions on shipping, and the first comment is trading sardines. So that's I got to tell you, there's two negative biases that you're fighting against. I'm not trying to start this off confrontationally. I'm actually going to have a lot of fun with this conversation. I hope you will too. Um, but is like these are trading sardines, and then the other thing that I immediately think is like, can the CEOs of any of these companies be trusted? Those are like the two questions that just like pop into my head.
Yeah.
So, what do you think about that?
Oh, I'm glad we're addressing that because shipping has a terrible name to it, and it's sort of like one of those things where everybody knows the legacy of shipping. And when people hear shipping, they always tell me, "Oh, is that like dry ships?"
Yeah,
Dries,
that's right.
because everybody knows about dry ships, and so it's
So, what
almost
happened to dry ships? Just for people that may not know.
yeah, so Dry Ships, DRYS, was a dry bulk company originally, but it had a very, I gotta pick my words carefully for legal reasons, but a very suspect governance structure and very promotional management and such. And the stock got picked up by a lot of, boiler room type operations and such in the mid 2000s, but there was a legitimate commodity boom going on. So the
Yeah,
company kind of rode the wave and were not very responsible with it. And at some point, the stock was like a 90 or 100 bagger in like a month or 6 months or something. And then that was a little bit before my time. And then whoever bought the stock lost 99.9999% of the company and it was
yeah.
taken private. So quite a saga up and down all the time.
Wasn't the dude doing all kinds of reverse splits and stuff like that, and like all kinds of things for index inclusion? He was an interesting
Yeah.
cat,
It,
if I
it was a
recall.
it was a messy business, and that was sort of dry ships 2.0, if you will. That was like in 2014, 15, 16.
Yeah,
Yeah, reverse splits, serial diluter, um, related party deals, right, where the company was just buying like assets from the CEO. I mean, all this kind of stuff that you would never. It was legal though because it was all disclosed. So
yeah,
that's what people think about when they hear shipping. And so
yeah. It
that's
sucks.
part one. Yeah, and that's the governance side of it, and that's part one. And it's so widespread that it's almost a truism. So like if I go speak to folks about shipping and the first like paragraph out of me is not something about like, oh yeah, the governance is terrible, people like tune me out. Like this guy doesn't know shit because
Yeah,
like this guy's a sucker, right? But you got to understand that there was about I'd say a dozen of these firms that came public at the top of the cycle last time around. This was
okay,
2006, 2007, 2008. And what happens at the top of the cycle? You get all the worst actors, all the worst
yeah,
players, all the crazy governance. It's like the SPACs. The first few SPACs we had a year ago probably had some really creative and cool ideas. But the SPACs that came out right at the end of the cycle, like what, March, April of this year was kind of the end of it. Those SPACs were, I mean, I haven't done any
yeah. Some
research.
interesting deals were getting done.
Right, or like crypto, right? You have like Bitcoin and Ethereum, and I'm not a crypto expert, but then you have like Doji and Shibuya, and like all this crazy stuff. So a lot of the shipping companies came public at the end of that wave, and the governance was a mess, and there's no sugarcoating that. That was kind of 2006, 2007, 2008 IPOs. The shipping companies of today, I follow about 55 of them, and this is on the U.S. market and the Oslo market. Those are the two main shipping where you can find shipping stocks. And of those 55, I would say at least 30 have outstanding or at least strong corporate governance and
Hmm.
management. There's probably another 10 that have mediocre, right, management, lots of conflicts of interest and stuff. And there's like 10 or 15 that are just like trading sardines and turds and shitcos or whatever you want to call them. And I prefer to not even talk about those companies honestly.
Yeah,
I just keep an eye on them to see what they're doing, but our service has gotten so big, we have over 500 members now, and some of these folks are portfolio managers, family office managers, and we just can't mess with those kind of stocks. It's just not
Yeah.
responsible.
So the reason that I wanted to talk to you is one, I've seen you make a lot of really good calls over the past 18 months, some of which have ended up in my inbox. And I've said, I can't even deal with this. I don't know anything about it, and I'm not going to start to learn anything about it. But I have watched what you've done, and it's been very impressive because I think you've been right for the right reasons. And the other reason that I wanted to have you on is I think that even if people are like, you know what, I'm not interested in shipping companies, like who cares? At the end of the day, what's going on in supply chains right now is something that I think everybody's got to be at least interested in. And shipping definitely ties into a lot of that, which informed your Dollar Tree thesis, which played out very nicely. So if it's cool with you, I'd kind of like for you to set the stage of like what shipping was going through in maybe 2018, 2019, and then what COVID did to the industry and supply chains generally, and just kind of talk through that from just like a analyst perspective of the environment more than like a stock perspective, if that makes sense.
Absolutely, Bill. And right before we get into that, I want to make this answer longer than it needs to be. But the part two of the anti-shipping, bad governance, trading sardines thing is we went through like a 7 or 8 year downturn after 2008. So that's important to
Okay.
remember too. So number one, the crappy companies, they went IPO at the top of the cycle. Number two, you had 7 or 8 on average very bad years. So people look at these stock charts and they're like, oh, these stocks are terrible. The governance can't be trusted. They'd always lose money. So that's kind of wrapping up the previous question. So
When they came public, did they spend a lot? Like, did the fleets get too big, or did they just kind of cash out in general?
well,
The
let's
bad actors, not all of the companies.
yeah, most of the worst actors were like these small like family fleets that had 6 or 8 ships, and it wasn't so much that the family themselves were bad actors, but they met up with a Wall Street banker or whoever he
Yeah.
was and she was, and convinced them that, hey, this is how you make the big bucks. And there's over 10,000 dry bulk vessels in the world fleet, over 10,000 large sized dry bulk ships. And so to have any scale whatsoever, if you don't have 50 to 100 ships, like you're a bit player, right?
Hmm.
Beyond smaller than bit player. And you had companies going public with like 6 ships,
So
like
what does a company with 6 ships even do? Like they're just kind of mom and pop scrapping around trying to load the boat, right?
it's just it's not even so much traditional shipping as you might think about it. It's more like a financial play, right? It's like a lease. They buy the ships, they get a mortgage from the bank, and then they like charter the ships out to somebody else who hauls the
Hmm.
materials. So yeah, it was all these little funky little stocks that had no business even being public. So I sorry to belabor that previous
No, it's all
question,
good,
but
man. This is your conversation. I'm just riding along with it.
I appreciate you, Bill. No, it's just important to get that out of the way because a lot of folks are just coming to shipping in the last 6 months or year, and a lot of folks came in last year with the tankers trade
Yeah.
and boom and busted, and I'm sure we'll get into that later in our discussion. But Bill, you asked a good question. You said, hey, what was going on in 2018, 2019? So back in 18 and 19, things were finally starting to recover after that 8 or 9 year downturn I was talking about, and across the board. I mean, shipping's actually like 6 or 7 different segments, and they all have their own unique supply and demand. So there's
Okay.
like dry bulk, which is iron ore and coal and grains and that sort of thing. That has its own supply demand, totally independent of the rest.
Oh,
And then
so
there's
dude, hang on, wait. I don't mean to cut you off. Let's pin this. But
yeah,
so you got dry bulk, and that's on the back of this huge commodity boom, right? Like all the bricks and the super cycle going into 2008, and then that all explodes. I would imagine there were too many vessels in that area for a while. Is that fair?
absolutely. All-time high rates. You had these old rusty 25-year-old vessels getting hired for $150,000 a day, and then the normal rate was like 12 to 15,000. Right? I mean,
Wow.
there was just absurd rates, and it
Okay.
was kind of like that tanker boom we had last spring. Only it didn't last 2 months or 3 months. It lasted 2 or 3 years. And
Okay.
so that's the kind of backdrop we had, Bill. And that was that again. This is 2006, 7, 8.
Yeah,
But
yeah,
but
yeah.
it wasn't just dry bulk. It was like every shipping segment had a boom in 6, 7, and 8, but it was for different reasons. And so because of that, the global financial crisis kind of brought everything down. But they each had their own trajectory of recovery, and they each
Okay.
had their own metrics to look at. It's not all shipping's hot today, all shipping's bad, tomorrow.
Yeah, that
Each
makes
segment
sense.
has its own thing.
Okay.
But we're getting off the path a little
No,
bit, but
yeah. Okay, so let's go back to where you were saying to set the stage. So there's dry bulk, and then what are the other categories?
Yeah, so just real quick, I'll hit the highlights on those. So there's dry bulk we talked about. There's container ships, which I'm sure you're probably the most familiar with. We're talking about a lot now. Those are the retail goods that come in those 20-foot or 40-foot boxes.
Okay.
Target, Walmart, Amazon. When most people think of like global trade and shipping, they're probably thinking about container ships. Then there's tankers, which a lot of people are thinking about because of what happened last year, and that carries the crude oil. It's like a big floating bathtub, more or less.
Yeah.
And
Those are dope, man. How they have the water in the what is it? It's in the hull, right? So that the ship doesn't get like too the weight is
yeah, they have ballast. They have ballast
yeah.
tanks, and they
That's
fill them
sick.
with water. Yeah, and it's interesting. You can Google this if someone's listening to this later. You can do like VLCC, that stands for Very Large Crude Carrier.
Yeah.
VLCC ballast, BALLAST, and then or VLCC laden. Right, and ballast is when it's carrying the water in the tanks and it has no oil, and they ride real high up in the sea.
Huh.
And then VLC's laden, the thing is like sunk in the ocean. And
It's
there's
like when
only
you
like
drop your car or something like
yeah,
that.
yeah. So like hydraulics or something.
Yeah, that's
Yeah,
right.
but
That's funny.
it's an astounding difference. And the
Yeah.
laden VLCC, it's like this weird floating barge looking thing going across the ocean.
Huh.
And when it's ballast, when it's empty, it's like on top of the ocean. So it's kind of funny.
Yeah, that's dope. I've watched
Yeah.
YouTubes on like liquid natural gas exportation, importation, and that's how I learned about these ships. They're very, very cool.
Fantastic. Well, that's a great segue because that's another type of ship is
Yeah. Okay.
the gas transports. And there's two different types. Well, there's more than two, but the two main ones are LNG, liquefied natural gas, and then LPG, which is liquefied petroleum gas or basically propane. So
Okay.
there's two different types there, the main types. And there's some other smaller ones, ammonia and some chemical gases and stuff like that. And then also on tankers, there's not just one type of tanker. There's multiple types. There's different sizes, of course. And then there's are you doing dirty, which is like crude oil, that sort of thing, or are you doing
Hmm.
clean, which is like refined products with gasoline, diesel, jet
Mm-hmm.
fuel, that sort of thing. Or and some of them even carry like veg oil, palm oil or something like that.
Hmm.
So all sorts of types of transports, and then you have like kind of the offshore type stuff.
So veg oil get like it's got to get crappy rates, right? Because that's not worth as much, right?
Yeah, and it's a much smaller, usually type of tanker that carries those. They're usually what's called the MR, the medium range tanker, the
Okay.
MR1s, or the handy size tankers. Those are a very niche trade. I mean, you don't have the very large million barrel
Yeah.
type ships carrying veg oil, but that's just something they can carry. And there's a lot of these little niche trades that go on around.
I just didn't know if they were like the stepchildren of the tanker game.
Well, they have their own, right? They have their own supply lanes and that sort of thing, and they're
Hmm.
pretty small, so that's actually not something I'm real smart on. So let's not get
That's
into
okay.
veg
I'm
oil
just asking
trades.
questions.
Yeah, you'll poke out my weaknesses here.
No,
Don't
that's not what it's about. I think it's interesting, man. You got to keep track of a lot of stuff.
There's a lot of stuff going on, and thankfully there's a lot of excellent data providers out there that we subscribe to via like our research budget at Value Investors Edge and stuff like that. Things that, for example, they track where all the ships are at, so I can log in and I can put in the name of the company I follow, and it'll show me where all their ships are at. And there's all
Yeah.
sorts of things like that that just kind of the average retail investor or even some hedge funds that don't really know what they're doing, like they have no idea what's going on. So
Well,
it's a
when I was thinking
very
about
asymmetrical.
your business, I was like, what's really smart about what Jay's doing is you are an expert in a niche that touches a lot of other things, and you can sort of like be people's research budget and almost be like I don't want to use the word platform, but it's what I'm thinking of. Like you can be the hub for people to get information and spread sort of the cost among a group. Like that's a smart business idea, man.
Yeah, I think you actually kind of nailed what we try to do. Folks sign up for our service, they're not getting investment advice. They're not getting like hot trades. I mean, I disclose all my trades, I disclose all my positions, but you nailed it. My job is to do as much due diligence and research as I can. Other folks read our reports and read our exclusive content, and they come to their own conclusions.
Yeah.
And I get things wrong. I probably I'm probably wrong at least, I don't know, 30, 40% of the time, but it's about making a lot of money when you're right 50, 60% of the time and not losing your ass when you're, the 30, 40, God forbid, 50, 60% that you're wrong, you don't lose your ass. And that's
Yeah,
how
well, you're not
shipping's
wrong
been.
that often. You don't need to
Well,
talk yourself down.
we'll have to see. I mean, if we were
That's my
having this
job is to
interview,
talk myself down.
if we were having this interview in May or June of 2020,
Yeah.
I'd probably be confident about shipping and preaching the virtues of it, but nobody'd listen, right? So it just depends. I mean, in 2021, I'm right about 92% of the time or something, right?
Yeah,
But
well,
in
that's a
but in
stock
May of
comment, right?
in May of 2020, I was wrong, 90% of the time. So
Yeah.
it depends.
Okay. All right. Well, let's frame this, because what really happened is you were right, but nobody paid attention to it, and you were able to make recommendations when things were very dour, and you were right. So that's like super. That's what caught my attention, man. Because I was one of those people that was like, I'm not fucking around with shipping right now. Like, no way, man. But that was to my detriment.
Yeah, it worked out really nicely. And the thing to want to point out, and I know we've went off the path a little bit, but the thing to point out is what I said is you want to make sure that you're making a lot of money when you're right. Because shipping's a volatile industry. Like I don't trip, fall, stumble in the shipping to make 10%, 15% returns. Like if I want to do that, I might as well just like ETF. Maybe I pick a value fund, right? Maybe I do that, but I just pick like an ETF of large caps or mid caps or value stocks or international stocks. Shipping, you want to make a lot of money when the sun's shining, right? Make that hay when the sun's shining. And when the times are bad, you want to be selected into enough companies that have strong management, strong balance sheets. You don't lose your ass. So like in 2020, we actually lost money on our model portfolios and me personally for a little bit throughout the year, but it was 6.8% is what our model portfolios were down.
Hmm.
This year to date, we're up about 135% on average on our
Is
models.
that good? That sounds good.
I think it's good. It's the
Yeah, that
best year
turns
we've
out it's
had,
good.
but it turns out it's good. It's more than double in 8 months. But
Yeah, good
it's
for
the
you, man.
standards. The standards are changing. In 2020, it was kind of the revolution of the retail trader. So in
Yeah,
so in December or November of last year, if you weren't doubling your money, like you were a nobody,
yeah,
right?
this is true.
But now reality is set in, and now you can actually start to segregate a little bit from the
Well, now you got to go to crypto for that.
yeah, you got to get into Dogecoin or something. But anyways, Bill, we've been all over the place. It's been great. But to circle back a little bit, 2018, 2019, things were starting to recover. The sectors were really starting to tighten up. It's all about supply, demand, and shipping, as in the world, but especially for shipping, because if you have one extra ship, there's kind of an old parable of sayings, but you have 99 ships and 100 cargoes, it's a boom, right?
Hmm.
But you got the vice versa, right? You got 100
Yeah.
ships and 99 cargoes, it's a bust. And that's mostly true. I mean, one or two cargoes or one or two extra ships in a key transport lane can make the difference between 10,000 a day and 50,000 a day.
Hmm.
Just one or two ships in one lane or one basin. So this is a very volatile industry. And 2018 and 2019, things were getting really tight. And we were looking forward at that time because we've been doing this service since 2015. 2018, 2019, we were kind of in the accumulate zone, and we were saying, look, not only are supply and demand turning up, not only are we primed for a secular, not just a cyclical turn, but also a secular turn because of all the upcoming regulations on uh, carbon emissions, on high sulfur fuels, all those sorts of things. And all those regulations are going to push out all this old tonnage. It's going to make it difficult to operate these vessels. And oh, by the way, supply demand's already tight. Right? So we were like licking our chops and stuff, and we were trying to get into these firms. And
Let's
in
assume I'm a 5-year-old real quick and don't know what tonnage is. The regulations are going to push out old tonnage. What does that mean in 5-year-old speak?
yeah, the old ships got to get strapped. They got to
Yeah.
get recycled. They can't compete. They're too rusty and slow and stinky. Yeah.
Okay.
Yeah, that's really it. I mean, ships are designed, it depends on what type of ship, but most ships are designed to do between 20 and 30 years of service safely.
Okay.
The International Maritime Organization is very strict on their classifications, on their surveys. International shipping is very safe. It's one of the safest industries out there, which is surprising. But you look up, like, people are scared of flying, right? Because they think flying is dangerous or whatever. Shipping's even safer, really, than flying. Like, there's very
Hmm.
few accidents. There hasn't been like a major oil spill in a very long time. There's been some small ones, but like,
Yeah.
ever since the Exxon Valdez and stuff like that, there's been a lot of very, very strict standards on these ships. So
Okay.
look, they're designed to do 20 to 30 years under this strict regime. And when times are really good, they're definitely pushing that 30. Maybe there's even 31 and 32-year-olds out there. But when times are bad, a lot of that stuff gets scrapped as young as 15 or 20 years old. So that's what I'm saying, Bill,
Okay.
is back in 2018, 2019, we're saying, well, we've been through a decade almost of downturn, but with these new environmental regulations coming out, those old ships burn too much fuel. They're not going to be able to compete. So the
Hmm.
old ships are going to go to the scrapyard. Well, once those ships go to the scrapyard, remember I told you, I was probably exaggerating when I said 2 ships, but 20, 30 ships, huge difference.
All right,
1%
hang
change,
on.
big
I'm
deal.
on a thought process and I don't want to forget it. So, what's your depreciation schedule on a ship?
So that depends on each individual company. So
Yeah,
that's
that
something
makes sense.
an investor should look into, because one of the things, remember I told you at the top of the cycle, the scammy companies come out.
Yeah.
These companies would have depreciation schedules, which were like,
Yeah, you
kind
tell
of,
people it's like 30 years and then your ship's got
yeah,
a 15-year life.
yeah. So they weren't quite that bad, but yeah, I mean, it would be like the tanker, for example, all the tanker firms said it was a 25-year straight line depreciation, which is like
Yeah.
BS. Like most tankers get scrapped at like 21, 22.
Okay.
Container ships, I think it was 30 years. LNG was 35. Yeah, the depreciation's pretty optimistic on
And your
those.
service, I'm assuming you're doing valuations off NAV, right?
Yeah, we don't price to book and price to earnings are almost worthless metrics in shipping.
Yeah.
They're just so easily manipulated by, for example, depreciation, bad accounting values of the vessels. Maybe they bought the vessel at like when prices were really high, so the book value is really high, but that just means you got ripped off. It doesn't mean you
Yeah.
have book value, right?
Yeah, that's a
Um,
good point. Yeah, you just
yeah,
have shitty capital allocation, low price to book. It makes sense. So
exactly.
how volatile is NAV on these
Uh,
things?
so it depends on how active the sales and purchase market are
Okay.
for bulkers and tankers. So dry bulk, remember iron ore, coal, tankers, pretty explanatory. Those are pretty liquid S&P markets. There's a lot of ship deals getting done. I think the
Okay.
last month alone, there's like 30 or 40 transactions done. So those values are pretty updated and pretty accurate, and they tend to follow the long-term shipping rates. You'd think so, right? It's a
Yeah.
efficient
Yeah.
market. I mean, it's based on if you think about what NAV really is, it's the market's estimation of present value of free cash flow,
Yeah.
right? It's what the market thinks that ship's worth, which is
Mhm.
based on everybody's inputs on NPV, basically net present value. So
Yeah.
those values are pretty good. I have a lot of confidence in those. Some of the other more niche sectors like LPG, liquid petroleum gas, LNG even, or even container ships. Right now, container ships are very active. They're very liquid. But you would ask me NAV 2 or 3 years ago for container ships. I'd be like, yeah, NAV. It depends on who you ask. You know,
Okay. That
you
makes
go to
sense.
the broker, you say, "Hey, what's the NAV?" And you're like, "Well, are you the buyer or the seller?" Kind of
Yeah.
know.
Yeah. That's fair.
Look, there's a big bid ask.
Widespread.
Yes.
Okay, that makes sense. Okay, so 2019, you're on the back of some of these environmental regulations. The market's tightening. Things are getting better.
Yep.
Uh, Continue.
We're just loving life. I mean, 2019 before this year. 2019 was the best year in Value Investors Edge history. It was a long storied history of 4 years, but it was the best year. And I have to pull up the thing later to say what the returns were, but it was a pretty darn good year. I think the average portfolio return was like 72% in our models. And I even
Wow.
said in our annual review letter, I'm like, if I never have a year this good in the rest of my life, I might be okay with that. It was a
Yeah.
damn good year. And we're just riding high. We're going into 2020. All the environmental regulations are coming into check. Global trade is booming. The U.S. China trade war has kind of petered off, right? It kind of wasn't really a thing anymore.
Hmm.
And we're loving life, man. Nothing can stop us. And
Yeah.
then of course, then
Except
of,
COVID.
then of course, we all had to start pulling out our atlas and figuring out where Wuhan was.
Yeah.
So that was a
Huh.
trip. Yeah.
So okay. So what happens when like what are you thinking in an industry with that much operating leverage? I think there's a lot of operating leverage. Maybe that's the wrong assumption, but it seems like it's the right assumption. And then
That's
the
accurate.
world stops. Like, what are you thinking?
Yeah, it's accurate. There's a lot of operating leverage, and some companies there's a lot of financial leverage.
Yeah.
So when the world stops or pauses or whatever you call it, you get out of the ones that have a lot of financial leverage. But here's the thing, Bill. Shipping stocks all started tanking and crashing, and this is I kind of riff on or trash on the efficient market hypothesis sometimes. I like to talk crap about it and say that I don't believe in it because otherwise why would I pick stocks? But shipping stocks or shipping investors or people into shipping stocks were way way
Hmm.
ahead of COVID. Like I'm
Hmm.
telling
Because they
you,
saw the disruption in China early.
I mean, we'd have to go back and really look at it and think about it and hire up some consultants and academics. But, I think it was like January 27th or 26th or something like that when Wuhan started being talked about, right? There was some sort of mysterious, flu going on. I think it was like late January.
Yeah,
And of
maybe
course it wasn't.
mid-January, but yeah, like
Yeah.
mainstream for sure was later on it.
Yeah, late January. And it wasn't until, oh man, early March that it was like obviously a global
Yes.
issue. Right?
Yes.
Is that fair? That's
Yeah, I
broad
do think
strokes, but
that's roughly right.
yeah, almost all shipping stocks immediately began tanking in the middle of January. I mean,
Wow.
back when COVID was like it was almost like a conspiracy theory. Remember like how there's all the weird Twitter videos and like, what is the
Yeah.
CCP up to and like what's going on over here and they're like
Hmm.
remember like they had like the truck going down the street like spraying foam on the sidewalks and just weird stuff, man. And shipping stocks were just tanking.
Hmm.
And by the time it was obvious, and I'll be the first to admit, like I would have never thought, we were going to be in a 18-month pandemic and still barely even past it, right?
Yeah.
Um, but by the time it became obvious that COVID was like a real thing, right, for the global environment, which was what, or you say early March, maybe? Is that fair?
Yeah.
I'm not like branded as like a
I
hindsight idiot.
wondered, do you follow Dan McMurtry on the Twitter machine?
I do not.
Super Mugatu. Yeah, he's the homie, but he wrote a good thread about what was going on, and I wonder if because he has insight into Asia through some like fund that he has and some contacts. I wonder if shipping. I'd be interested to see the intersection of those two timelines.
It would
That's
be very
wild. That's a
interesting.
cool leading indicator.
It is, and it's funny because it's such a small. The shipping is all the market caps of all the shipping stocks put together, especially back then when they were a little smaller. I I'm kind of rounding, but I'd say maybe 5 to 10 billion is like all the shipping stocks put together. I mean,
Hmm.
all the U.S. ones. There's some big ones like Maersk and stuff that are European, and there's some big
Yeah.
Asian ones. But if you just look at like the U.S. kind of maybe 10 billion is probably
Hmm.
about right. And so you're looking at a 10 billion market versus the S&P 500, which I think was like three or
Yeah,
four
huh? And
trillion.
the small one is telling you what's really going on. That is kind of wild.
Exactly. This 10, 20 billion market is wildly predictive and efficient, and this huge $1 trillion market is sleepwalking.
Hmm.
And although you could also argue that COVID wasn't so bad for stocks, so maybe the big market was right and shipping market was wrong. But anyways, Bill, you get where I'm
Yeah.
going with this. Um, Look, by the time it became obvious to me, and I'm like, dude, I'm into shipping, man. Like I would say our service is I would say probably. You got to be careful, humble pie and
I've
everything, but
talked to people. You don't stop talking. I've talked to people about you, and they're like, "That dude is as plugged in as it gets."
okay.
The
So
the only question that I've had is I've wondered if you're too plugged in to see the industry for what it really is.
oh, okay. Well, some people say, right? Some
No,
people
no,
say that our
that's
service.
not what I'm just sometimes if you're that involved in something, it's kind of hard to get yourself out of it. But I don't think you are. Like, I mean, the reason I'm talking to you is I've read your stuff. You sent me articles. Like, I think you're an intelligent cat. So that's why I wanted to have you on.
Oh, that's nice, Bill. Yeah, no, but some people say I meant for me, like puffing up my ego. Some people
Oh
say that
no,
Value Investor's Edge is the best in the world. You'll never find one better. Some people say,
people are
um,
saying.
people are saying it is known. No, but look, I mean,
Who's
by the
saying?
time
Many people. All the people. What are you
all
talking
the
about?
people, yeah, right. 3 a.m. Twitter, and I'll be ready to go. No,
Oh,
so
that's funny.
look, like, look, by the time myself and I would say our team, because it's not just me at Value Investors Edge, but by the time we really wrapped our heads around COVID, and we're like, this is gonna be bad. This is gonna be painful, guys. This isn't just a Wuhan, China. This isn't just CCP conspiracy theories. Like, this is a global pandemic. By the time we came to that conclusion, and again, hindsight, we maybe look like idiots, but every single shipping stock on average was already down like 50, 60%.
Hmm.
So I was like, by the time you actually came to the conclusion and did your research, you're like, well, shit. I mean, why would I sell now?
Yeah.
So there was really no chance to sell. And the thing is, all these shipping stocks are down 40, 50, 60%, and the S&P 500 hasn't moved an inch yet. I mean, it was
Hmm.
down like it was what 2% down or 3%. There was like
Hmm.
that. There was a couple weeks where it was like really volatile every day, but it didn't really go anywhere. It was kind of like up and down. It was like a roller coaster. And then I think it
Yeah.
was like mid March with the lockdowns and Right, we had the hedge fund guy that went on TV and started crying, and then like the market
Hackman.
crash.
I
Yeah.
don't. Yeah, I think this is fake news, man. But
uh,
whatever. He did call the bottom through his tears. But
yeah.
yes.
So
Anyway,
so anyways, by the time Ackman was on TV and crying, like it was time to buy shipping. If anything, it was too late. And what gave
I
us
will say, I gotta
yeah.
say, in his defense, he said, "I am unwinding my hedge and I am getting long." He did actually telegraph everything he was doing. You just had to actually listen to the interview. But anyway, I digress.
Yeah, it's like Nixon versus JFK. You gotta listen to the read the transcript.
Yeah,
don't
that's right. You
don't watch
actually,
the yeah.
yeah.
Don't
He's a bit of a
overtake.
Rorschach test. He's got a lot of haters, so I get it. Whatever.
Yeah, I didn't come on here to hate
You
on
should
him.
have
I
been
just
buying shipping by the time that Acton was crying. That's the
well,
end of the day.
yeah, I mean, and you should have sold shipping in January 16th based on like the first tweet that emerged, right? I mean, it was
Yeah,
like literally like there was just random tweets coming out about like nothing really confirmed,
probably when
substantiated.
Ackman was buying the CDS swap.
Probably was. He probably talked to the same guys. He maybe his CDS swap was tied into shipping somehow.
I don't
I
know.
don't know. I don't know, man. But that's kind of what happened. So
Yeah.
look at that point, the damage was done. And so I got a lot of folks saying like, "Oh, we dump here, do we sell here?" And I'm like, first of all, I can't give you investment advice, but second of all, we know all these companies inside and out. The balance sheets have never been stronger. Yes, we're facing uncertainty. Yes, it's a global pandemic, but the leverage has never been lower. The governance ratings on average have never been better. I have basically a personal line. I'm maybe not a phone call, but definitely an email with like every single one of these companies. Like I've been in the industry for almost 10 years now. So I know what's going on over there. Things are fine. Yeah, there's
Hmm.
going to be a bumpy. I mean, like, yeah, like Q2 20 financial report's going to suck,
Yeah.
but none of these companies are going to have financial problems. And of the 55 shipping companies that we loosely follow, and I say about 40 that I would say are decent companies, right? The other 15 are kind of like watch out for those. But of those 40 companies we follow, not a single company did a single dilutive equity issuance, had a
Hmm.
single credit default, had a single adverse action, nothing.
Hmm.
So I mean, it was like the stocks fell, but like for no reason. And
Well, did
so
they?
that will
They
stop there.
didn't have enough liquidity to get through the cash burn, I presume, right? So they had to issue a fair amount of debt, or is that
Um,
not correct?
no, I mean it was like the
Wow.
balance sheets were never like the balance sheets were so strong coming into this thing,
Hmm.
and the market was so. I mean, it wasn't boom. It wasn't like it is now, but the market was so good in 2019 and starting out really good in January of 2020 that the liquidity was high too. Cash balance.
Hmm.
Now if COVID would have been like Q2 20 for a year or two straight, then yes.
Yeah.
But we all know that it was not, right? It was only bad for like 3 months.
Yeah. I wish that you had been like, look, idiot, open your eyes. These balance sheets are good. Stop. But, there's only so much you can do. You can only lead the horse to water, right?
I mean, emotions are high, and you know, in times like that, when stress and panic is high, and blood pressure is high, and losses are flowing through the portfolio, people lean on gut reactions and common sense, right? And
Yeah.
common sense is that in a global pandemic, you don't want to own a shipping company.
Yeah.
So I don't fault anybody, for wanting out at the bottom. And I don't fault anybody today for saying I don't want to get in right now in September 2021. It feels like the top because they look at a chart. I don't fault anybody for that. It's gut
Yeah.
reaction, right?
But I do think, and I'm going to plug you here for a second, that people that are listening to what you're saying, there may be some insight that they can glean whether or not there's a stock investment from the service that you provide. Right?
Yeah, I
Because
certainly, I
because
certainly hope so.
Dollar Tree says that supply chains are going to be fucked up through 2023. That's a long time. So
Mhm.
presumably you've got some information that may help some people, myself included. Maybe we can work something out. We'll see.
I hope so, and that's the pitch I make to a lot of folks too. Is it's like, look, you might not care about these shipping stocks besides maybe a quick trade, but they can apply to a lot of other things. I mean,
Yeah.
shipping, the global logistics is what makes the world go round, as we've realized. We hear that Christmas might be late, Christmas might be canceled. So now people are paying attention. But yeah, you mentioned Dollar Tree, and that's a perfect example of like the crossover. I
Yeah.
was I gotta give credit because we're on a podcast here. I gotta give credit to a guy named Nick First. He writes on Seeking Alpha. He's actually the first guy who brought up Dollar Tree. I mean, he brought up
Hmm.
this thing. He brought it up way ahead. I mean, like in February or March. He was like, "All right, shipping, was kind of the first or second order of this thing. What's kind of the next to third order?" And he's like, "Well, we got to look for retail companies that are going to get screwed." And so he's
Hmm.
actually the guy. He actually sourced the idea. I won't take credit for that. I traded it well, but
Yeah.
he came up with the idea, and so I started following Dollar Tree. and I put on a small short. I'd say low five figures ish, small short into Q2 results, which was I think in June, and they did the results, and I was actually like, I looked at the earnings report and I'm like, shit, this is a pretty good result. Like I'm gonna lose money on my short. And but somehow I got lucky, Bill. And there's a saying, it's better to be lucky than good. And somehow I like tripled my money on those puts. So I was kind of like, well, better lucky than good. Like I'm getting the hell out of here. Dollar Tree looks like their business is strong. But then I said, no, wait a minute. I'm gonna read the transcript of the call. I'm gonna listen to the conference call. And I listened to the CFO get on there, and the CFO is saying all the numbers, and he's talking about how shipping expenses have increased. But then the CEO gets on, and he starts making some comments about like, oh yeah, it's short-term disruption shipping, it'll be back to normal in no time.
Hmm.
And I'm like, this guy doesn't know what he's fucking doing. Like this guy's got his head in the sand.
Yeah.
And so then I'm like Dollar Tree,
Time to lay it.
yeah, you write it down on your little notepad, and it was kind of like it had like a strike through on it, right?
Yeah.
And then I just like circled that thing like 18 times.
Do not forget this.
Do not forget Dollar Tree. And I go back into my world, my sandbox of shipping, and lo and behold, it's time for Q3 earnings. And I look at the price chart, and it's back above where it was before Q2. And I'm like, it's time to lay the short big, you know. And I mean big for medium,
Yeah, whatever. But that's how you did it. Yeah, that's cool.
This CEO has no idea what he's doing. Like this is gonna be bad. And he gets on the conference call and total change of heart. The guy found Jesus. He's on the conference call like, oh, this is gonna be. You said it yourself. It's gonna be screwed up till 2023. Like we had to charter a ship ourselves. Like this is gonna be a mess. It's gonna add to our expenses. And he was optimistic. He's like, we're gonna get to the other side. But he was much more realistic. He was like an actual. Is like a leader. Like I could get behind that guy. Like, okay, he's found Jesus. And so, the stock went from 105 to like 91, which when you're playing puts,
that was a tough report.
Yeah. And that was like in 2 days. And I actually covered my short too early. I only made 3.5 times my money.
Oh.
It actually went down way more. It went down way more though. I actually covered it. I'm not short Dollar Tree anymore. I don't think Dollar Tree is a great short for like a year or two. I think it was just an event. Business. Yeah, it was an event, but that's an example, Bill, of like how you can kind of plug and chug some of the shipping stuff into other sectors.
Yeah, for sure. Yeah. So when COVID occurred, like why are supply chains so messed up right now?
Yeah, that's the $1 million question. So a little bit of history on that is that after global financial crisis, all the governments worldwide basically pulled back on their capital spending. I mean, the U.S. had the stimulus, right? We had the, shovel-ready jobs and all that, but that petered out after a couple of years. And ever since then, Europe's been in kind of austerity mode, right? We had like the Greek crisis, the Italian crisis, and all that kind of stuff. The United States, has been wrangling politically over dollars and stuff, but the port spending and infrastructure investment has been significantly underdone in the United States and Europe for 10 years straight. Another facet of that is all the new port technology is all automation. It's all about replacing workers with computers and automated forklifts and cranes and loading equipment. All that. Like if you go to like YouTube and like Google, if you go to YouTube and search like Singapore container ship hub or something like a container ship Singapore, just put that in. You'll get like these videos that show you the automated terminals, and they're like a modern marvel. They're amazing. In the United States, every time they try to install automated equipment, you get the unions up in arms. Right? So domestic political economy, lots of pressures against that. In China, the container ports work 24/7.
Okay.
24/7, 365. In LA and Long Beach, like they get Saturdays and Sundays and nights off. We don't take it seriously. Like we didn't invest in it properly for 10 years straight. But it worked, Bill, because everything was on time. Remember, just-in-time shipping and logistics was like the hot thing. Yeah. Everything was just in time, right? The ship would pull up with the cargo on schedule, on manifest. They'd unload the cargo. They'd put it in the warehouse. They'd put it on a train. The train would take it to another warehouse. They'd put it in the truck. Nobody really gives a shit about this, but like that's how like your stuff shows up at Walmart. Right?
Yeah,
like it's a 25-step process. It doesn't just show up there, right? But everything was just in time, and so there's just enough warehouse space. There was just enough capacity at the port. There was just enough freezer space in the back of Walmart to hold your TV dinners. Right? Like everything was like automated and just in time. Well, with COVID, you shut everything down for 2 or 3 months, more or less, right? So you got this huge log jam. All the ports are closed. China's like quarantined. US ports are like halfway shut down. Ships are like getting rerouted. Like all this crazy stuff's is happening. But Americans are still living their lives. Right? They're
Yeah.
still eating food. They're still buying. In fact, they bought more than ever,
Yeah,
right?
that's
Because they
right.
were getting stimulus checks and they're like, "Oh, this is my office now. Like I actually don't go to work. I actually have an office here. So I need to buy a desk. I need to
Yeah.
buy a new monitor. Oh, by the way, I'm playing more video games than I've played in my life. I need to buy a new graphics card. Like
Yeah.
all this consumerism started happening because people weren't traveling, people weren't going on vacations, people weren't going to the bars and the restaurants. So they were replacing that by buying goods.
Yep.
So we completely depleted the nation's inventories of like everything. I mean, whether washing machines, toasters, computer monitors, keyboards, like whatever. It was all like depleted. And you got this logjam of ships. Well, then the economy opens back up and we're trying to spin everything back into shape, but we're in this system that was like running at 98% capacity on just in time.
Hmm.
And now you're trying to shove, I don't know, it's like trying to think of some non-cheesy metaphor. I don't know, but shoving like a hot dog through a garden hose or I don't know, like whatever. It was just,
Yeah,
it
no,
had a
it's
long time
really
to get
hard
there.
to restart it. Like really hard.
Exactly. And so everything's getting delayed. Oh, and by the way, every, 6 weeks there's like a new random event that happens. Like the
Yeah.
Ever Given jamming up the Suez Canal. Like,
Yeah.
oh, by the way, like that happened. So yeah, it's been crazy.
Yeah, that was a wild story to see because as somebody that knew nothing, I was like, okay, this is probably like a big deal, but I have no idea how big of a deal it is. And you probably knew like immediately this isn't great.
Yeah, I got to be careful with that stuff because, of course, no loss of life, no serious loss of property, and so you don't want to like celebrate other people's misery. But a lot of shipping investors were very enthusiastic and excited about that ship, and probably
So
hoped
why
that it
is that?
would be good.
Like to somebody that doesn't understand, why is that good? Like day rates go up and what like stuff is just stuck on a ship and that's a good thing? That would seem like it would reduce your turnover.
Yeah, like at first people be like, "Oh, that's bad for shipping." No, look, so shipping is all about supply and demand. So supply of the boats, the vessels, the ships, and demand. And demand is measured in something called ton miles. So how much cargo are you carrying, and how far do you need to take it? And there's actually a third dimension to that. It would be ton miles times speed, right? How fast are you going
Okay.
to move your ships? So that's kind of like the Newton's law or whatever of like shipping, right? Shipping demand. So if you think about what happens when like the Suez Canal was constructed to be a time saver, right? You don't have to go all the way around Africa. You can just cut right through the Med. Panama Canal was constructed to be a huge time saver. Right? You don't have to go all the way around South America. You can cut right through Central America. So if you think what happens to global demand measured by ton miles times speed, right? When the Suez Canal is completely jammed, it's pretty significant. Any ship that's going, east to west or west to east either has to wait for 1, 2, 3, 4 days, 2 weeks, like nobody knew, right? Or it has to go all the way around Africa, which adds like a week.
Okay.
Yeah, it adds a week each way to the voyage. Um,
Yeah.
so most ships didn't go around Africa. They're like, no, we're not doing that. But they had to wait because I mean the cargo is already ticketed. It's already going somewhere. They can't
Yeah.
just turn around and head home. So they just sit there in a queue. Well, the queue gets longer and longer and more jacked up, and so it had an effect. The canal I think was jammed for was it 4 days, 5 days? It had an effect that is still being realized today. Like it had like a two
Hmm.
month or 3 month cascading effect on global supply chains.
Yeah, that's wild. I think that people don't like and I maybe I'm internalizing, but I actually do think I've been I haven't been able to put numbers on it, but conceptually I've been pretty decent at thinking through the supply chain. People are like, why is stuff so messed up? And it's like, because you can't just start this stuff again. Like everything was run so efficiently that when you break a system that's not built with any slack in it, it's very, very hard to get that system back up and running at an efficient rate.
That's
I
exactly right.
understand that much. I don't know how to quantify how hard it is, but that I know.
That's exactly right. And it'd be, I mean, it was fortunate for us that nobody was really getting into this stuff a few months ago, but I'm glad you're able to pick it up and understand it so fast. the problem is a lot of people are like, oh, it's that stock's already doubled or that stock's
Yeah.
already tripled. I'm too late, So I think a lot of folks shot themselves in the foot in maybe March or April of this year because they looked
Well,
at a
I'm
stock.
guilty of that as well. So I'm not going
Yeah.
to pretend that I'm beyond that, but I sort of understand what's going on.
Yeah, but I mean, I guess that's the kind of point or segue I was making is when you have access, and it doesn't have to be, our service. Our service is a little more pricey, but if
Well,
you have
many people
access,
say yours is the best service.
all people say, Bill. Nobody says it's not. But look, I mean, if you have access to a service like ours, you can see the valuation numbers of these companies. You can see the kind of operating cash flow they're pulling in. You can see the demand forecast for the next couple of years, and you can understand like, oh yeah, the stock doubled or tripled, but the cash flow is so massive that the enterprise value is barely even moved. And that's the
Yeah.
thing that happened for us in like March or April is a lot of folks such as yourself started understanding, oh wow, this is like a big deal. But they looked at a stock like they pulled up the Nows Corp, DAC, and they looked at that stock and they're like, oh man, the thing's already a 7 bagger. Like I'm too late. Well, it's tripled since then, right? So it's been now,
Really?
yeah, now it's like a 19 bagger or something.
Wow.
Yeah, yeah.
Oh, I'm so glad I ignored this. This one I'm not going to add to my list of misses, but I will add to maybe next time be radically open-minded. Um, I guess the question that I have put to you, and I'll put to you now, is okay, great. There's all this free cash flow today. Why does it come back to the minority shareholders? Like, why doesn't it just get spent on boats or wasted somewhere or whatever? Like, why do I benefit from that cash flow?
Yeah, no, that's a solid question, a good one to ask. That's why you want to make sure that the management team is aligned with you and the management team's responsible. And you want to look at a company like I mentioned at Nows Corp, and you want to look at their 20-year track record. I mean, what happened last time? The markets were good. Did they pork it away, or did they learn their
Yeah.
lesson? What are their returns policies? What are they saying? Mostly, like I can talk to or call or email most of these folks, and most of them are fairly transparent and straightforward. But you can see like what's their dividend policy. And so I think that is probably one of the biggest critiques, and I'd say it's a valid one at some point. That's one of the biggest critiques against a company like the Nows Corp. It's like, well, yeah, but their dividend is only 50 cents a quarter, and that's only $2 a year, and the stock's in the 80s. That's a pittance. When am I getting my reward? And what I would say to that is right now, the company is only 1 year removed from being in a very tough financial situation. The stock was only $4 a year ago. The Nows Corp right now, we're recording on September 9th, so it's like 85.50 right now. If I pull up the 1 year chart of the Nows Corp, it was $4.98 a year ago. So that's 17 bagger. And so right now, yes, the dividend's only $2 a year, but the guy at the company, the owner, the CEO owns 30% of this company. And he's like, yeah, like I get it, but like, dude, that's $2 dividend. The stock was 5 last year. Let's get some stability under us first.
Yeah.
Let's pay off all our debts. Let's
Yeah.
make sure that we have no outstanding obligations. Let's make sure that like everything's rationalized, and then we'll talk about huge dividends. Right, so I actually think he's
That
being
pisses
responsible.
off the IRR driven guys, but like it's
Yeah,
definitely the right thing for the business long term.
exactly, and that's what I think. I think what a lot of folks get kind of bent around the axle about is I've never seen so many armchair CEOs or CFOs or whatever than I have in
Yeah.
shipping. Like everybody thinks they know more than the shipping CEO and CFO. And again, Bill, last decade, not very good for shipping. And there was a lot of scammy, shammy managements. So it's not when people think that they know better than like the company, but they're basing that off realistic evidence, but it's also a bit of recency bias, right?
Yeah.
It's what they saw the last decade. And, a lot of people just want the company to dump out all of its cash immediately and stop investing in shipping. And I mean, that's like asking, American Airlines to never buy a new airplane, like it,
Doug Parker's not going to do that. He's
yeah.
addicted to new airlines. But that's a example that I happen to have a lot of beef with. I don't know if you know this, but I followed the airline industry.
Oh man, I picked the wrong example. I picked the wrong metaphor.
I hate American Airlines.
Okay. Well, as a customer, I'm with you 100%. I don't know anything about their stock.
You know what I don't like about them, man? They ran a levered buyback strategy on an airline, and he ran with like leverage out the ass, and he was like, we're never going to lose money again. And, like, was COVID foreseeable? No. But I think he actually, I kind of blame him for giving that industry a bad name.
Well,
And he's welcome to come on the pod and we can debate this fact. And I'm not trying to throw shade. I objectively think like all these things when you're like, look at the leverage of the airlines, look at all the buybacks, do that all and adjust American out of that and tell me how it looks.
wow, that's very interesting. And I can't really, I'm not qualified to comment on that.
But
I, as a customer,
you hit me in a pain point.
as a customer of American Airlines, they are definitely not on my top list. They're definitely on the top 3 of the wrong list to be on. But yeah,
United had some leverage too, to be fair. But like the airlines were not crazy. They're asset heavy. They're not going to have no debt. That's insane.
No. I mean, like airlines is, and I don't want to spend too much time on airlines because that's not my thing. We can do
it. I'll go nuts.
Oh, we can. I guess we can talk longer. but like airlines are an interesting little example of an industry that's arguably way better off now after COVID and after filling their coffers with government aid and after right sizing or downsizing their staffing force. And I mean, airlines have I mean, Delta, I think there's some stat that like Delta has like 20 times more cash today than it did before COVID or something like that. I mean, it's pretty wild.
Possible. They got a lot more debt, but
it's wild.
Yeah. I don't know. You got to do your own research. Fake news out there. But, so how is COVID, like how are the labor forces dealing with COVID right now on the ships? Or is there like a ton of testing on it? And like, is it causing problems still?
So that's definitely something that slows everything down. And just to get, I'm not really qualified to talk maritime policy, international maritime policy here. But one thing that really frustrated me, it really ground my gears, if you will, during 2020 and into this year, is that the international community was very, very slow at recognizing maritime workers, seafarers, as essential workers.
Oh, like, that sucks.
I'll go right out there and say that, like, because I mean, we're not going to say anything about medical, but after medical, I'll go right out there and say that there's nobody more important and more essential in our economy than those who run the supply chain. Yeah. Like without a supply chain, civilization's over. Right. I mean, like that's as essential. I mean, right. And I think after medical, seafarers are by far the next most essential good to our economy. I mean, without a doubt. And the international community didn't come around to recognize that for a long time. So you had a lot of folks on ships that, due to the hodgepodge of different countries having different rules and different regulations, couldn't go home. Right? They couldn't get switched off. They couldn't get refreshed by a new crew. They weren't eligible for the first waves of COVID vaccines. So there's definitely a soft part in my heart for all the seafarers out there. I know a lot of the more responsible companies have been raising their wages, have been offering bonuses and some of that stuff. And I would encourage, as a shareholder in all these companies, as much as possible to compensate these folks fairly, especially when we're in the middle of a boom. And in the future, it really needs to be looked at from, again, I'm not global maritime policy expert, right? I'm a shipping investor, but I would want, hopefully, the United Nations IMO to really look into this in the future. Like, how do we strengthen our global supply chain infrastructure? And how do we make sure that these seafarers, if this happens again, God forbid, that there's not so much chaos next time around?
Yeah, no doubt. You all right if we go to the Twitter sphere for some questions?
Absolutely, let's do it.
All right, cool. So let's see. What are the most common red flags that you would look for in a shipping company? Or, I mean, this could be any equity for that matter, but shipping specifically.
Yeah. No, I think the very first spot you want to start off with is you got to open up their annual report. So it's the U.S. listed firm. You go to the SEC. I go to the SEC Edgar Index. That's where you look up the SEC filings, and you type in the company symbol. And if it's a foreign located firm, headquartered, you'll have a form called a 20F, 20-F. That's what they put out. If it's a U.S. firm, you'll have what's called the 10K. So I think more folks are probably familiar with the 10K. I would do a Control F on that document and put in related party. And, in the newer forms, you'll have like a little hyperlink. It'll take you there and stuff. But these companies, by law, are mandated to disclose all their related party transactions. If you don't, it's big time fraud. And we haven't had really a case in shipping in 20 years of any sort of fraud. I mean, all this stuff that's been done has all been disclosed. So like people could read these filings and see all this stuff.
I don't know that it's not a ton of comfort, but I agree with you. At least it's out there.
Well, yeah, but I mean, like, dry ships.
I agree with
I
you.
was
I'm just
very,
laughing.
very anti-dry ships. But like, I mean, it's like Control F related party transactions, and you fall off your seat, and then you get back on your seat and you start reading, and you've fallen off your seat 17 times before you get through the document. So yeah, I mean, it was bad. So that's the very, very first thing I'd look at, and before I do anything else, I mean, if you're reading those related party transactions and it's either like you can't understand what's going on, or if it's like some spooky, scary sounding stuff, like just take the stock off your radar. Maybe it's a trading sardine, right? It's over a day trade or something, but that's not an investment.
Yeah,
that's the very
first. It sounds like there's enough out there that you don't have to mess around with that stuff.
Yeah, I don't think you really need to. But I mean, there's been a few good trades, and we do a little bit of it, not too much because our service is really too large. I mean, like if I go out there, maybe not me personally, Jay Mintzmyer, but like if I say to people, hey, this stock, small $100 million, $50 million company looks interesting, that's a lot of folks looking at a company, and it's just not responsible. So yeah, we don't really do that, Bill. But yeah, that's step one. Step two, step three. You really got to figure out where the cycle's at. And is it tankers? Is it container ships? What's the supply and demand look like? And that's easier said than done, right?
Yeah.
But that you got to have it doesn't have to be in the nuances, Bill. Like, I mean, you don't have to be like, myself, Jay Mintzmyer, our macro guy, James Catlin. You don't have to be like 17.3% demand growth expected over the next 5 years. Like, you don't have to be that far in the weeds. But, are times really good? Are times really bad? Are they getting better? Are they getting worse? What direction is the arrow going? That's kind of the next step there. And then I guess step three is just classic value investment research, right? What does the balance sheet look like? What is the return on capital been the last 5-10 years? That sort of thing that any value investor should basically be doing with their companies.
So following up on point number 2, it sounds like from our conversation that starting in 2018, 2019, the industry got healthier. Right now, things are kind of wonky. You've got a little bit of traffic jams. What do the next 5 years look like, and how do sort of like environmental regulations? I've read that environmental regulations are going to hurt the older ships in the fleet. Like, what does this all look like? How many ships are going to be delivered? Like, how do you put on your kind of where we are in the secular trend? Forget about sort of a short-term cycle.
Yeah, absolutely. In that sort of dynamic, you'd want to make sure that you're correctly bracketing and bucketing your 6 or 7 different segments. So when I look at the order book for LNG carriers, liquefied natural gas, it's a lot different than what I see for dry bulk. It's a lot different than what I see for tankers.
Makes sense.
It's a lot different than I see for containers, and so on. And then you want to look at the delivery timings. How many ships are coming next year in 2022? How many ships are coming next year in 2023? And it's all very granular and detailed data, and that's where we subscribe to other folks who compile that for us. Like, it could take months, years to compile all that stuff. So we subscribe to something called Clarkson's Shipping Intelligence. Would highly recommend that one. Vessels Value is another one I subscribe to, and these are not entry level services, right?
Yeah,
but those are the
like,
types of.
I used to have Informa. What are they? They got to be like, I don't know, 50, 60 grand a year or something like that.
It depends what package you pick out, but anywhere from high 4 figures to low 5 figures a year. Yeah. So
Okay.
Yeah.
Yeah.
So yeah, I mean, and that's just how. And it's not. I mean, you can read news reports and get a rough idea of how big the order book is or how big the demand projections are. But if you want the granular, like, this is no shit, like the quarter or sometimes even the month that this ship is expected to hit the water, you gotta pay up for that data. But that's what you look at. And you, like I said, you want to look at the 6 different segments and figure out where we are in each one. And but not everybody has that much time. Right, Bill? I mean, it could be a lot of work. So maybe you just start with one segment. Maybe you're just like, hey, everybody's talking about tankers. Let's look at that one,
Yeah. Well, making money takes time. Unfortunately, this is a difficult game.
Yeah,
It'd be nice if it wasn't.
Yeah, right. We'd all be billionaires. Yeah.
So I've got here. How are you constructive on tankers? I got to ask. My man Relic Phillips is asking. He's a big fan.
I think now is one of the best times we've had in the last 2 or 3 years to be buying tanker stocks, but you have to be buying the ones that have a solid balance sheet and have a management team that you're you trust, that you're okay with being there, it might take a year or two to turn around. I'm not quite as optimistic about a near-term recovery as I was back in February or March. And that just has to do with how long COVID's dragging on and out. Tankers are the one segment where COVID and the global economic kind of slowdown associated with that really matters, because we have to see the oil consumption, we have to see the jet fuel consumption. The other stuff, LNG, LPG, that's used for heating, that's used for power production. Container ships, that's used for retail goods. So as long as we don't have a global depression of sorts, those can recover and do okay even during COVID. Tankers, we have to get past COVID in terms of like jet fuel demand and overall oil consumption.
That makes sense.
Yeah.
When you wrote up Zig recently, you called it asset light. Can you explain to me how a shipping company is asset light? It seems like it's all off balance sheet, yeah?
More or less. It's sort of, I got to be careful with my analogies because you nailed me on American Airlines there. I put my foot in my mouth.
No, I won't do it to you again, man.
But it's an asset light model. They're leasing in all their ships.
Yeah.
And so they don't actually own, I think they own one ship out of 118. Yeah.
All right.
So that's asset light. And so it's very, they can be a little bit more responsive to this cycle. So I guess since you brought that up, there's a pro and a con to it. We'll talk about the con first, because I think that's all most people focus on is the cons of it. And the con is that whatever lease you sign up for, you're kind of stuck with it, whether it's a 2-year lease, a 3-year lease, a 4-year lease. And right now rates are at all-time highs. So the leases you're signing aren't very favorable. So if the global shipping stuff, like the supply chain stuff, Bill, if that gets fixed by like mid 22, well, they just signed a bunch of 3, 4, 5-year leases. And so that's not going to be good. That's kind of the negative. That's the con. But the pro of it is that they can structure a lot of those leases almost like a laddering structure, where each quarter they can renew or cancel a bucket of those leases. And if there's a huge technology or regulation change, like some of the stuff we've kind of alluded to, or, we get to 2025 or something in the future and they say, oh, there's this new technology that's carbon neutral or carbon free or whatever.
Yeah, they can pivot quick.
Yeah, they don't have these long-term obligations, very quick, within a year or two. Whereas all these other companies that own these 20 or 30-year assets, try selling an asset when the market's bad. I mean, you don't want to do that. Yeah.
That makes sense. All right, now I'm going to satisfy my own curiosity. How many people are over at Value Investor Edge?
So membership-wise, around
employees, like what's your personal business look like? What's it been like to grow it? Are you enjoying it? Like, let's talk about you for a second.
Oh, yeah. Well, right on. Who doesn't like to talk about themselves, right? So
yeah.
Just pour another cup of coffee here. No, look, I'm glad you brought up the Value Investors Edge thing, because it's not just like the Jay Mintzmyer show or whatever. We have a team over there. And one of my long-term business partners who contributes a lot to the service has contributed a lot to a lot of the good calls we've made. Couldn't have done it without him. James Catlin, he's a macro guy. He does all the kind of high-level supply and demand analysis for us. And of course, he leans on heavily the data services that we pay for, but he interprets them. It's like they provide the hieroglyphics and this guy translates them, and I decide what to do with that translation. So we're a team. I mean, he does the high-level macro stuff, and I do the micro. He does top-down, I do bottom-up, right? So that's kind of the dynamic duo there. We have a very good associate researcher that has worked with us now for about 1.5 years. He was an intern for a while, and now he's a full associate researcher, Clement Mullins. Yeah, really good guy. He's in his final year of university in Spain, and he's doing a bang-up job. He does a lot of the continuing coverage of shipping companies. So I've already been there, done that, written the models, designed everything that's going on, met the management, dialogued. I run a podcast, not as illustrious as yours, but it's a very focused. Some
say this is the most illustrious. They consist of just me.
They all say this, Bill.
Yeah.
They all say that. I've heard them all.
Many people are saying.
Yes.
Yeah.
So
my own mind, at least.
My own humble, nowhere near, couldn't even approach the shadow of your podcast. We call it Value Investors Edge Live. And so what we do is we bring on the CEOs or CFOs of these companies, and they're live. I think this one's actually recorded.
Oh, that's dope.
So this is recorded, right? So if I say something stupid, you can edit me out,
Yes, correct.
Well, so these ones are live, and I almost do it like a conference call. So folks in Value Investors Edge can hop right on this conference call live, and we bring on.
Cool. What platform do you use?
So right now I use GoToMeeting. And if
Nice.
I'm doing slides, I use GoToWebinar, and
Yeah.
that works well for us. We have about 500 members. We usually have, I don't know, anywhere from like 30 to 100, depending on how hot the company is. 30 to 100 that attend live. And if you don't attend live, I put up the recording later. I commission a transcript of it as well.
Yeah.
So
That's
it's
dope.
it's yeah it's been successful for us. But look, that's kind of something we offer that's part of the team, and so Clement assists me with that, and he does some of the earnings modeling now. I have to actually hats off to Clement. He actually quarterbacked, if you will, a lot of our Q2 estimates. Like, I
Nice.
guess and check and trust and verify, but no, he nailed it. He's done a fantastic job for us. So he's our third guy. I work with a guy named Michael Boyd who does energy, basically exclusively energy infrastructure.
Hmm.
And so if I
I
want to
was
know
wondering how you covered like energy too.
exactly, because that's not really my wheelhouse, right? So
Yeah.
if I want to know about like the latest LNG plant developments or like how this new pipeline in Texas is going to impact crude oil exports, I call up Michael. I call him up. I'm not in 1995, send him in.
Yes, on the landline.
Fax
I
it
hit him
over.
on his beeper first.
fax me the solutions. Yeah, so Michael Boyd does all our energy stuff. And then I've hired a couple guys that do kind of background things, like make sure our analytics platform works well and make sure the IT side of the house works well. So it's really a team.
That's cool.
Yeah. So thanks for asking. I'm glad we got to talk about that a little bit.
Are you currently in school? Yes. Is this Harvard that you're at, or were you at Harvard?
I'm currently at Harvard. I attend the Harvard Kennedy School. I'm a second year PhD student there.
And you're a PhD of what?
It's going to be public policy, but it's focused on international relations.
Huh.
So it's almost like political science if folks aren't as familiar with public policy.
So why are you doing that?
Yeah, so I'm very interested. This kind of backs us up a little bit. So I just started talking, I guess, from like a dollars and cents capitalism perspective, like, oh, I like shipping because it's an inefficient market and I can make money at it. But bringing that back a little bit further, ever since I was a little kid looking at trains, romanticize it a little bit. I've always been curious about, global supply chains and global trade and like, what's that box says Costco on it? Oh, but
Yeah.
that's not Costco like the store that my dad takes me to. It's spelled differently. COSCO. Like, what is that? What is Hanjin? What is HMM? What are these things and where do they come from? So that's always been a curiosity of mine. And then as I went to my undergrad, I studied economics and I learned a little bit more about international trade and trade agreements. My master's program at the University of Maryland was international security and economic policy. So
Okay.
it was a really neat blending of the two facets. And my actual my project course, we didn't call it a thesis or a dissertation, but my project course was my assignment, or what I picked to do was study the Trans-Pacific Partnership. That was really hot in like 2013,
Oh, wow.
2014. Yeah, it was before President Trump got elected and put it straight into the shredder.
Yeah.
But,
So you were happy that all your work went to nothing.
yeah, it was really wonky and then really sad. But yeah, so that is kind of my underlying like academic background and
Do
credentials
you have
and
opinions
motivation.
you're willing to share about the TPP? Or
Yeah,
not really?
yeah, we can talk about the TPP
I'm
a
just kind
little
of
bit.
curious. I mean, you've studied it way more than I did. Did you kind of like the idea of it, or like kind of what'd you think?
Yeah, I think the idea of it is something that most people, when they start thinking about what it is and wrap their heads around it, most people agree on the ideas. I think a lot of folks got a little bit concerned about whether or not we were sacrificing too much in terms of like giving up some of our tariffs and protectionism and stuff like that. The original strategic nexus of the Trans-Pacific Partnership was to sort of contain China. President Obama gave this very kind of landmark speech, and he said we're going to pivot to Asia. And he said there's going to be two parts. It's going to be military. We're going to decrease our focus on Europe and the Middle East. We're going to increase our military presence in the Asia-Pacific region. And then he said economically, we're going to focus there as well. And Trans-Pacific Partnership was kind of the policy-oriented like trade nexus of that pivot. And what Trans-Pacific Partnership did was it brought in, I think it was a total of 17 countries in that region, which was basically the who's who of that region besides China. Right?
Yeah.
And we hammered it out for 3 or 4 years. I mean, this started middle of the Obama administration, and it was in the final stages at the end of the Obama administration, start of the Trump administration. Unfortunately, the messaging wasn't very good back home domestically. I don't think a lot of Americans understood that this was strategic, that this was meant to cement United States is a key player in Asia and sort of box out or contain China. I don't think a lot of Americans realize that. A lot of Americans thought like, oh, this is like an Asian NAFTA. Like our farmers are going to, not do so well, or there was a lot of misinformation going around. And so it was ironic, and I can talk about this a little more because he's the past commander in chief and past president, but it was ironic that President Trump was so focused on, addressing China. And I think it was absolutely correct that he was focused on addressing China and trying to address those trade deficits. But on day one, and it was a political promise, I get it, you want to keep your political promises, but on day one, he shredded like the most important policy tool that we had in the toolbox to address China. So maybe that's all I should say for now, but that's kind of my feelings on it.
That's interesting. It's a cool thing to have deep insight into. I would venture to bet that not many do.
It's a very niche topic, but that's why, like, I'm at the PhD level here. I'm studying the intersection between global trade flows and security policy. So, like, what do these trade flows mean for, our military or long-term State Department strategy, and how should we address them? So it's very correlated to all that previous stuff.
That's dope, man. So how'd you get into investing?
So, yeah, it's a good question. I just really basic, man. I think back to like high school, we did like a stock picking contest or something. I'm like, oh, these are stocks. I grew up in a very like, frugal, kind of old fashioned blue collar middle class family where, stock market was rigged and it was a casino. And like, that's kind of what I was taught as a kid. So it wasn't like a childhood fantasy or anything. I didn't really get into it until college, really. I was 18 and we were in the middle of the meltdown back then, 2008, 2009. And I think I put like $1,000. It was like a big deal too. That was $1,000 was like a lot of money. And I put $1,000 into my first brokerage account. And I bought, like they say like beginner's luck or beginner's curse or whatever it is. Like my very first stock that I bought was Ford.
Oh yeah.
And it was like $2 a share, and or I think it was like $2.50, and I put like 500 into it, and then it was like $1.80, and I doubled down.
Nice.
And I got very lucky and fortunate.
Yeah.
And so
because I know the outcome.
Yeah. So my dumbass sold half at 4.50 and half at 6, but it went on to be like $14 a year later.
Yeah.
But that was kind of like that was my first taste at how markets worked. And I got lucky, and it was like, oh, this is kind of fun. This is kind of cool. Oh, I can actually research. It's not like a casino like I was taught at home. Yeah. It's actually like a informed market. Like, oh, wow.
That's cool. And then you started writing when?
So about 3 to 4 years later. So when I had the first bite of the apple and taste of that, I dove in head first, man. I was at the Air Force Academy at the time, and so life there was very rigorous between military and academics and that sort of thing. But I had the bug, man. I had to get into it. So I must have bought 15 or 20 like beginning investing books. I mean, like Peter Lynch. I even bought like a book that had like all of Warren Buffett's annual letters and like Intelligent Investor. You have to mention Intelligent Investor. It's like talking about talking about religion. Talking religion, not mentioning the Bible. Like you have to, whether or not how many lessons I got out of that book or. But
well,
no,
there's only 2 chapters you really need to read, right? But everybody needs to read them, I guess.
Yeah, if you haven't read that book, you don't know what you're talking about. But no, like, so I must have read 15 or 20
That's what my camera
books.
is sitting on right now.
Oh gosh, yes.
My story is my grandma's friend sent me 2 books. 2 of them were Bogle books, and one was The Intelligent Investor.
Oh wow.
He must have had like a sick sense of humor because I mean, I read The Intelligent Investor. I did like it, and then here I am. Trying to figure out this world of active investment. It's I got to tell you, it's a really fun pursuit, right? It's one of the most interesting pursuits in the world, but we'll see at the end of it all if it was worth it.
Yeah, well, hopefully we won't see the end of it all, so to speak. But but I mean, give enough time, there's only 2 things that are certain, right? So look, it's one of those things where it started out as a hobby. But it's a hobby that has transformed itself into a very successful business, and the trading itself has been very successful as well. So that's a blessing. Like, and I don't take that for granted. And there were some tough years, and there were some tough moments and tough lessons learned getting here. Oh, you'll like this one, Bill. You'll love this. The first stock I ever shorted was American Airlines.
Ah,
yeah,
good man.
Good man.
Was your timing any good or no?
Oh, so let's talk about that. So this was. It's so long ago. I don't know if I got my year correct. It was like 2010 or 2011. It was a long time ago. It was right after the the GFC, and their balance sheet was a wreck. But they'd gotten enough bailout money to like stay afloat. Right, but they had like, what was it, like 5,000% debt to equity or something crazy. So look, man, I didn't know what the hell I was doing. My entire brokerage account was like 10 grand. So I was long a few value stocks. I hadn't really gotten to shipping yet. I was long, I think it was like Best Buy and Microsoft, and I was in GameStop before GameStop was cool. But
Yeah, I
look,
think
man,
every value investor kind of looked at GameStop or touched it at some point. It
yeah.
was on Greenblatt's scanner forever.
Wow. Some of my first articles on Seeking Alpha going back to like 2012 were actually on GameStop. And I was part of the first, I think it was like it was like $20 and it went to 50. Like I was part of that.
Yeah?
I was part of that way back when. I mean, this was like 2011, 2012, 2013.
You're the OG Roaring Kitty.
OG, man. I only made 3 times my money, not 300 times or whatever. But so I didn't get called before Congress, unfortunately. But
Yeah, well,
no,
that's
but
a good thing.
so I didn't know what the hell I was doing, but I figured out you could short stocks. Like, oh, this is cool. I can look for bad ones. Like, like it's hard enough to figure out the good ones and like figure out what people are going to think is the good one, because that's really what you're trying to do, right? You're looking for good companies, but you're trying to be the first one that finds the good company. And so shorting was like blew my mind. I was like, oh, this is a whole new paradigm. So I'm going to short American Airlines. They're going to go bankrupt. I know it. And so I shorted like some stupid amount of my portfolio, like 30% was short American Airlines, and I naked shorted. I didn't even know what options were. I didn't even know options were a thing, man. It's like 2010. And so I didn't know what puts and calls and this. So I was short the stock direct, and I think I went short at $7 or $8. And it went from 7 to 9. I'm like, oh, this is kind of painful. And it went from like 9 to 10. And I got like a nasty email from my brokerage. What is a margin call? I had to Google that one.
No.
And my account's like 9 grand or so, like I'm a college kid. And basically I got an angry email from them. And I remember this. It was $11.30 is where I ended up covering my short. And I mean, dude, it was like I lost like 2 grand, like what, but back then that was a lot of money.
Yeah.
I mean, that was a lot of trips to Qdoba.
Yeah,
oh shit, that's a lot.
Yeah.
How many burritos?
Ramen for a while. This
I can't go to Five Guys this Sunday. Shit. So that was a big deal to me, man. And you know what was insult to injury, Bill? You know what happened next month?
It had to go down.
The next month they went bankrupt. The very next month. It was not 3 weeks later. I shit you not. 3 weeks later they went bankrupt. And the stock was brutal. The stock that it becomes like an OTC BS stock. It was 22 cents. So
that's brutal. Well,
3 weeks later,
a nice lesson in risk management, I guess.
yes, sir. And I lost 2 or 3 grand instead of 300 grand or something.
Yeah.
So
I had a conversation. I've got this. I'm very conflicted because of what happened to my cousin with Robinhood, and I was talking to Tom Sosnoff from Thinkorswim. And it was a hard conversation for me to have because he talked about like how much he liked crypto assets and how much he liked the derivatives and how he didn't think that stocks were like efficient, that they cost too much. So he was like, a stock is $600. And I was like, yeah, but it's got like, $30 earnings under it. It's not that but it made me realize that like he was talking about it from an inventory merchant perspective, right? Because he's a market maker. And I wish that I was quicker on my feet in that interview. I had COVID, but I think I was just kind of had a dumb moment because it ended and I was like, man, I kind of messed that up. But it made me realize like he was one of my first introductions to investing, right? Or trading. And where I've come from that is so far. And without that initial introduction, and I'm not even sure like his way works for people, right? It's not the way my brain works, but it works for some people. And I do think like lessons like you learned and me learning a little bit of an expensive options education, like an introduction to financial markets is probably a good thing on average. I do kind of wish some of these brokerages took a little more of the responsibility in house instead of just kind of letting externalities into the world. But
Yeah, absolutely.
I don't know. It's kind of, that story is like fun to laugh at now, and look at where you are. That's awesome. So
Yeah, it turned out well in the end, but to kind of bring our points back together, Bill, I would say that it's so important for folks to get that practice. I mean, it's real money, it's not practice, but to get that exposure early. It's not like voting.
yeah,
You vote early and often. You get that trading experience early and often. You start as young as you possibly can. And if it's too late for that, because the clock, is not where you want it to be, start small. Maybe if you have 100 grand that you want to invest, maybe put 90,000. I'm not investment advice, right?
yeah,
Don't quote me. But maybe you put 90,000 in like an ETF or something of the market, and you put 10,000 into the stuff that you're actually trying to trade. And you learn your lessons, and they hurt a little bit, or they feel good if you do well. But you do that for a while, and I mean a while is several years at the
yeah,
lowest. It's not 3 months. And I think
yeah,
that's what got a lot of people last year, Bill, in 2020, is a lot of folks came in, they had the right intuition. They're like, the market's tanking, it's crashing, it's collapsing because of COVID. COVID's not going to be here forever. I'm going to come in. I've never touched the stock market. I'm going to come in and I'm going to start investing. And I think most of these folks had the right idea. But it's kind of like getting into drugs, It's almost like
yeah,
it was almost like meth or heroin, man. It was like, you get
yeah.
that,
And
you
then
get
it
those
starts
first,
to go up, and you're like, oh shit.
and you think that you don't realize that, oh, this is kind of lucky, or oh, this is kind of a thing. You think like, oh, I've got the touch,
Yeah,
and I think, I hate to see it, but a lot of those folks got just demolished in early
yeah.
2021, and it's sad to see it, but it's because they didn't take enough time to learn the mechanics of what was really going on. So maybe a little bit of a Dutch rudder CJ going on here, Bill, but I think it's a valuable lesson.
Yeah, I mean, one of the reasons I'm going to run the Tom episode, this will run after it, whatever. If you're a listener, sorry for how you're hearing this conversation, but that's how the schedule works. Sorry, it's not immediate. Um, he always had, one of the reasons that I wanted to highlight him is he always led with education.
Mhm.
And he was always like, trade one freaking contract at a time. Like when you're young, right? If you want to put on a put spread, buy one. Like you don't need to. And his point now is like, everybody trades too big. Everybody wants to get rich way too quick. And I think about that a little bit with concentration because, I pray to the altar of Buffett, but like I also am smart enough to know that he's way smarter than me. And I'm smart enough to know that a lot of the people that I talk to on this program are way smarter than me. So I either need to be like hyper disciplined on where I play or be less concentrated or some middle ground. I don't really know what it is, but
Certainly.
trade small.
Yeah, you can never
That's
go
my
wrong.
takeaway. That's the only thing that I will tell people as advice. And then go find a fucking financial advisor and don't listen to me.
Yeah, absolutely. And look into those related party transactions and incentives. I joke,
That's right.
related party, but look into your financial advisor too, and make sure you're picking
Yeah.
someone good. And yeah, absolutely, Bill. And even something that I would say to folks on Value Investor's Edge is, I'm like, guys, and this is something I would say, even 6 months ago, I'd say this, or even today, I would say this. Hey, look, I've been doing this in shipping for 10 years. Like I have proven track record going 5 or 6 years on Value Investor's Edge of pretty strong returns. But look, I do 30 or 40% of my own money in this kind of stuff. And I do 50, 60% in either it's blue chips or it's index funds or it's cash, or it was my house for a while, right? It was a big portion of my assets a few years back. So, even myself, like with as much of a track record as I have, with as much confidence as I have, we're talking 30% or 40%. And the rest of it is the index. And I think, you can never go wrong with that advice of, education first, and then starting small and building yourself up, those building blocks. You can never go wrong with that.
Yeah, that's dope, man. Well, I've had a great time talking to you. I'm glad that we did this. Where can people find you, and where should they sign up for Value Investor's Edge?
Yeah, absolutely, Bill. It's been great to be on tonight. So the easiest thing, and it's free as far as Twitter, is at Mintzmyer. So hopefully you'll have the spelling of it there, but Mintzmyer. I know the Meyer is not spelled quite correctly, but at
Well,
Mintz.
that wasn't really your choice. You were sort of born into that.
At Ellis Island Shenanigans. So yeah, at Mintzmyer, you'll find me on Twitter. About 12,000 followers there, and I put out a high level commentary and notes once in a while. I won't be tweeting at you at 3 a.m., but I'll have some stuff for you there. As far as the research platform, that's probably where 90 to 95% of my stuff is behind the paywall. That's just kind of the way it is. 5 to 10% is what you see on Seeking Alpha or what you see on Twitter. Behind the paywall, you can there's a link to it on my Twitter, or I made it easy. I have a redirect link. You can go to www.mintzmyer.com. I thought that was a cool website, so I had to buy it. So go there, and it'll redirect you to the landing page, and you can learn about our service and learn a little bit more. If you have any questions, at me at Twitter, or send me a message. I try to respond as much as I can on Twitter. There's 12,000 followers, and some days are more hectic than others. But if you tweet at me, I'll do my best to respond.
All right, we'll drop you in the show notes. One last question, and then I'll let you get out of here. What do you think Twitter has done for your marketing, the level of conversation? How is it similar to Seeking Alpha? You grew up on Seeking Alpha and were there when it was early. Like, how do you see those two things?
It's a really good question. I think any sort of person who is, sharing their research or doing any sort of thing like that needs to have a handle on social media. And I'm honestly behind the curve. I was ahead of the curve on Seeking Alpha, right? I've been there for 10 years. So I was when it was a baby and I was, partnered with it. But, Twitter, I was a little late to the game. I got there about 2 years ago is when I started taking Twitter seriously. And so even a year ago, I had a couple thousand followers, and now it's 12,000 something. So Twitter's been good for us. The engagement's great. It's fun to meet a bunch of new folks that don't even really know what Seeking Alpha is. I have a presence on LinkedIn, but I just haven't really got the same traction there. And Facebook, and Facebook, I had a page there for a while, but it's just not the right environment. I don't have a single. I should mention this kind of weird fact about Value Investor's Edge. Most people on Value Investor's Edge are professional acquaintances, right? Like, I don't sell this research, too high priced probably, but I don't sell this research to friends and family and stuff like that. So like Facebook, like I don't go on Facebook and post about stocks. I mean, that's where you see like AMC and GameStop and stuff, I don't do that kind of stuff. It's just on Twitter.
Yeah, that's cool. Well, thank you for stopping by, man. I hope people got something out of it. We could have gone into the weeds, but I figure that, if people like what they heard, they should sub to your stuff, and then they can find out the actual weeds.
Yeah, well, I appreciate you, Bill. And if anything, if things keep going like they are now, if the trend keeps persisting, I'm sure there'll be something in a few months we'll have to circle back and talk about. I don't know whether it'll be another port getting shut down or another ship getting stuck in the canal or another crazy spike in rates, but there'll be something to talk about exciting, and I'm glad you're looking at it.
Well, I'd enjoy it. So until then, take care of yourself, and thanks for stopping by, man.
Excellent. Thanks, Bill.
But it's absolutely necessary